Good morning and welcome to this timely FESE webinar. I'd like to thank you for joining us this morning, which promises to be a very informative discussion about one of the major topics of recent MiFID review, the consolidated tape. We know there is already heated discussion about that, and I hope today going to be a major contribution. As a FESE president, I have to start with reminding everybody what we exchanges are standing here for. We are playing central role in serving the real economy, providing capital to the companies, delivering neutrality, transparency, reliable price formation, and risk management. But our role is very important on the primary markets. We are bringing the companies to the market. We nurture those companies seeking access to the finance through the public markets. Today, we will get a presentation of newly launched study of Oliver Wyman, Caught on Tape. And we are very much looking for it. As exchanges, we welcome this important contribution to the debate because we believe that cost-benefit analysis is actually one of the first steps have to be done in any kind of project, especially such a kind of difficult project of the pan-European scale. As you will see the results of this project, first and foremost, the lack of quality of the reporting of SI and OTC trades must be addressed. Policymakers should ensure that the market structure fit for purpose. Consolidated tape cannot be seen as a substitute for adequate market structure. Let me now briefly take off my hat as a FESE president and go to where I came from as a CEO of the smaller market in Central Eastern Europe. We very much watch the development of consolidated tape with other exchanges, and we think it can undermine our efforts. With the MiFID 1 and MiFID 2 experience, which probably served perfectly for pan-European blue chips and its liquidity, we saw that it led to many cherry picking and make actually our ecosystem weaker and more vulnerable. We, together with the 13 other CEOs of the Central European Stock Exchanges, get it together, and actually we are very much worried about the results of the tape and about the potential effects on our market, which can be devastating. And we would like to have policymakers gathering and assess also the effect of the consolidated tape on small markets, because I believe bringing SMEs into the markets and bringing ecosystem in the smaller markets to work for CMU is one of the crucial points of the Capital Market Union. Again, I have to stress, consolidated tape will not be fixed for all for CMU, but it can help increase the transparency, especially in systemic internalizers and OTC space. Therefore, I very much welcome the study of Oliver Wyman. Discussing these points and many others, we have a great lineup for you today, including John Berrigan from European Commission, who is leading DG FISMA and the work on this. Now I hand over to Rainer Riess, FESE Director General, our host of the morning. Rainer, the floor is yours.
Thank you very much, Peter, and welcome everybody to our webinar, Caught on Tape. My name is Rainer Riess, Director General of the Federation of European Securities Exchanges, and I will be your host today for the webinar. And let me start with some introductory remarks about the MiFID review and what we need for transparent, fair, and competitive European markets. First of all, I want to make very clear that exchanges in general welcome a consolidated tape if designed properly. We stand for transparency, and in that spirit, we are very much for anything that will help transparency to increase. And the Oliver Wyman study is a very important contribution, in my view, to make the right choice for Europe, improving transparency and avoiding the pitfalls of unnecessary costs or risks that a wrongly designed consolidated tape could bring. But let me begin my intervention by outlining what a consolidated tape will not fix and what needs to be fixed independently in order to create European markets in financial instruments that deliver for CMU, for investors and issuers. And as Peter was already alluding, I think MiFID 2 and MiFIR have been a big step forward, but they also have so far failed to address one of their major policy objectives: increase transparency and bring more trading into the light. Much to the contrary, Europe has become a much darker space. And a precondition for a meaningful tape is to address the challenges raised by fragmentation and opacity, and to ensure that a level playing field and a well-functioning price formation process to the benefit of European issuers and investors, particularly retail, exists. The challenges to this are multiple. A capital market union and a sustainable recovery from the COVID-19 crisis, in my view, cannot happen without well-functioning capital markets. And it's very important there to stress it needs to be both primary and secondary markets. They're two sides of the same coin. If we want to issuers and investors to re-enter capital markets, we need to restore trust in the efficiency, stability, and transparency of the market. And core to this is obviously ensuring that Europe has an optimal price formation process. Now, let me start by showing maybe a couple of slides, and I'll start with the first one. Today, the EU trading landscape is highly fragmented, with more than 250 execution mechanisms for equities alone. In total, it's more than 600, from which there are currently 85 SI operators. This is clearly a highly complex environment, many more execution venues than, for example, in the United States, and presents a considerable challenge, not only for price formation, but also for supervisors to ensure that there is a level playing field. Since the implementation of MiFID II, overall, we have witnessed lower levels of transparency and a drop of market share of lit trading. And you see the open order book is only around 40%, since a significant share of trading volume is still executed in the dark. OTC is around 27%, and SIs are at 20%. Dark MTF trading, to maybe mention that as well, is around 5%. These are ESMA figures, but in the slide displayed, you can clearly see that the objective of more transparency has not been delivered, and to the contrary, the dark trading has increased. So looking at these trends, in our view, the priority should be to simplify the EU equity market structure with a view to achieving more transparency, efficiency, and also fairness in European markets. Let me maybe show you a second slide, and it's a slide we used in the MiFID I and MiFID II process, and it very much shows a bit what is the difference between the execution venues. The intention to create SIs and permit bilateral trading is to allow for large trades to be taken on the book of an intermediary and shield that larger order from market impact. That is the old upstairs trading, because in the old days it was done going up some stairs and doing this upstairs in a closed room. But let's look at slide 2. This comes with privileges that regulated markets and MTFs don't enjoy. SIs can discriminate whom they take on as a customer, only doing business with customers to their liking. They need not to adhere to the same pre-trade transparency regulation. What they need to show is much lower in terms of pre-trade transparency. And also they provide today very poor data quality in the post-trade reporting. They do not need to comply with reasonable commercial basis obligation when selling most of their data. And by the very nature of bilateral trading, they can earn the spread. That is very justified for risk business in size, where they need to be compensated for committing their balance sheet. That is something that always existed, but it's a free lunch for smaller trades since there is not such a risk. If we look at the SI data in the first half of 2021, we find that about 80% of SI trades are below standard market size and have an average trade size of only 3,000 euros. 99% of SI trades are below LIS and the large in scale size and have an average trade size of 28,000. That is what I would call a free lunch and a very unlevel playing field to the detriment of functioning price formation. SIs executing small order flow don't bear risk. There is no capital commitment. And to such an extent, it is not only a distortion of the level playing field, but it's also a cannibalization of the price formation process and not fair treatment to retail investors. And we all know less liquid instruments and representative prices translate to higher spreads and volatility. But what can the MiFID review do to tackle these problems? Beyond enforcing existing rules, it is key to ensure that SI venues are held to the framework to which they originally were intended, and that is of providing for large in-scale trades. And to this aim, a tightening of the SI regime is necessary, which would include increased transparency requirements and restricted trading by SIs to the LSI threshold. Alongside strengthening the price formation process for the benefit of European companies, and overarching focus should be placed on the interest of end investors, notably retail investors. This is, in my view, critical to ensure that investors have the confidence to participate in European public capital markets. In particular, there should be focus on venues that offer zero fee trading for retail investors, as well as payment for order flow regime. Some FESE members have conducted extensive research in this space to demonstrate that regardless of the zero fee offer, best execution is not achieved on these venues, proving that rent is still extracted despite the headline offer in a very intransparent manner. But let's come to the consolidated tape and let's consider what is really delivering a clearer picture of European liquidity. The first priority, in my view, is to increase data quality. Data quality originating from OTC and SI trading remains deficient, which mainly results from fragmentation, exemptions from the transparency regime, and a lack of enforcement of rules. Therefore, data quality, consistency, and availability at the source has to be improved as a matter of priority. Without doing that, SCT will constitute another data aggregation exercise without any clear regulatory use case, but an additional cost for market participants. So really, provided that the data quality issue is sorted out, we agree to an EU consolidated tape, but not one that favors certain players and places more costs on EU firms. Some players want a tape that only shows prices of transparency market, claiming that only addressable liquidity should be on the tape. This means that significant volumes of business conducted by these players will not be on the EU tape. And if the key is to see 100% of transactions, then obviously market dynamics have to be understood and have to be transparent. So through the tape, some market participants want to get market data for free and then really use this for their commercial purposes to execute orders and allowing them to internalize cheaper and earn the spread between buyer and seller. Well, that also, I think, is not the intention of a tape and should not be allowed to really do free riding on the investments of transparent markets. I think it's also important to be careful when certain market participants speak about the cost of market data. They often mean data which does not fall into the general accepted understanding of market data, as they use many other types of data. And the exchange markets data spend is actually very small. It's about 0.5% of buy side and 0.10% and about 10% of the sell side market data spend. So in short, an EU consolidated tape will not be a silver bullet for resolving the identified issues around transparency and price formation. When it comes to trading on lit venues, the majority of volume is covered by existing data providers and is available today. The real problem and the real challenge for a comprehensive consolidated tape to be in a position of adding value is the lack of data quality from the gray and dark parts of the market, as well as the fact that these parts of the market are not accessible for many investors. Well-designed tape is even more relevant for growing markets. In those regions, exchanges support the local ecosystem by bringing together the local companies with investors, and Petr referenced that. And a too intrusive consolidated tape legislation will put those markets at stake, going against the objective of the capital market unions in the EU 27. In closing, I would like to highlight again that only a coherent MiFID review fostering transparency together with a reliable and complete post-trade data will strengthen capital markets and benefit investors and issuers. An improved equity market structure and a well-calibrated consolidated tape, a CT, go together. But how can we make this happen? Well, it is crucial that the design of the equity market structure takes priority and is simplified. Restricting SI equity trading to large orders above LIS only would be an efficient way to incentivize lit trading, ensure the quality and robustness of price formation, and remove the complexity currently embedded within the market. And a precondition to a reliable CT is the improvement of SI and OTC data quality. And we think that what Oliver Wyman proposes, a 15-minute delayed step, seems like a feasible option to start. We are still advocating for a tape of record, but I think both are options that probably can achieve the way if the market structure issues are solved. We need to ensure the EU is equipped with a comprehensive vision to strengthen EU public capital markets, both within the Union and on a global basis, and work with the industry to ensure that these markets play a full role in the economic recovery from the COVID-19 crisis, as well as accompanying digital and sustainable transformations. We stand ready as European exchanges to participate in this process. And with that, I turn over to Magnus Burkl. He's principal at financial services at Oliver Wyman, and he will present us the highlights of the study. Magnus, the floor is yours.
Thank you very much, Rainer. And I'll quickly also try to share my screen with everyone here. So hello again, and thanks everyone for joining today's webinar. Over the next 15 minutes or so, I will present the summary conclusions of the report on the consolidated tape that we as Oliver Wyman have written, and walk you through some of the key considerations on that. My name is Magnus. Rainer kindly introduced me. I'm one of the co-authors of the report. I work at Oliver Wyman. We specialize in corporate and institutional banking, wealth and asset management. So we really serve the entire capital markets community. And I myself, I've worked for the last 7 years now in that space. I'm working with banks, brokers, the asset managers, but also the market infrastructures. And that was also very important for the study because, quickly to the background, the study was commissioned by FESE, but it was fully independently developed and produced by Oliver Wyman. And we took really the perspective of the entire capital markets, looking at all participants on the buy, the sell side, the market infrastructures, the institutionals, the retailers, and made sure that we reflect what's best overall for European capital markets. We looked across the entire value chain, which is important because as of now, there is no regulatory-driven use case for a consolidated tape that could be evaluated. So we looked at all processes in the capital market space and looked to which extent do they use market data today, and to which degree can they benefit from a consolidated tape. And what we looked at was really what's the quality of the market data that's needed for that business process. How comprehensive does the market data need to be to add value above and beyond what is currently available from market data providers? And most critically, how quickly or how timely does the market data need to be available in order to add value above and beyond what is currently there? We didn't develop this in a closed shop. We have written this independently, but we have discussed and challenged our views via interviews with market participants. And we really spoke to all different types of market participants, also reflecting different business models. And we discussed and challenged our perspectives. And in the end, we stand the way that we thought is the right one for Europe. And I can tell you some of the debates have been very heated and emotional. And lastly, before I start walking you through some of our conclusions, how we interpreted the study and how we wanted to add value to the debate is by providing a cost-benefit analysis on different tape options. And we know the debate is not new on the consolidated tape, and many options have been discussed previously, also in the public debate. And we went through these options step by step, analyzing which option is really the best one for Europe, acknowledging that there are costs involved, there are risks involved, but also there are potential benefits to be reaped if the consolidated tape is well designed. So much to the background of the study. I jump to my next slide, which is the recommendations from the report. In short, what we recommend is a 15-minute delayed consolidated tape for equities, equity-like fixed income that covers data comprehensively from all trading venues, but equally from all execution venues, be that SI or OTC. So really from every occasion where market data is created in Europe to be fully comprehensive. How to read the slide that I'm broadcasting. So you can see 4 different tape options that we have looked at: a pre-trade real-time consolidated tape, a post-trade close to real-time tape, a post-trade 15-minute delay tape, and a post-trade end-of-day tape. And then you see 4 different assessment dimensions: whether the tape improves European market transparency, whether it provides benefit and to which degree, and what the challenges and costs are for the different tape options. I now go from left to right, explaining how we arrived to our conclusion, starting with the pre-trade real-time tape. And this tape option is something that we think doesn't make any sense for Europe. The benefits are pretty small, and it's technically almost impossible, very difficult to realize, given the latency issues we have in Europe, the technical requirements it would need, and the high risk specifically with respect to arbitrage and the customer protection concerns it would raise. So the pre-trade real-time tape is something for us. And by the way, also no one of the 40 interview partners we had advocated for this. So this tape option is something that was sort of least preferred and ranked lowest in our assessment. A post-trade close to real-time tape has the biggest benefits, stemming from the fact that close to real-time supports the largest amount of business processes in the capital market space, but it also comes with an incredible difficult cost challenge and also realization challenges on how to implement this. So whilst it has the biggest benefits, the implementation costs and also potential risks stemming from misuse, for example, make this option our second priority option, because the costs, so to say, outweigh the benefits for the close to real-time option for now, and specifically for a first-time implementation of a consolidated tape in Europe. For a post-trade 15-minute delay tape, we find that it still supports most of the processes in capital markets. Not all the processes, some processes require real-time, but most of the processes along the value chain are sufficiently served with 50-minute delay market data, if it is comprehensive, if it is of high quality, and so on. The technical challenges and also the cost to realization are acceptable. The infrastructure for that is largely already available across the industry. So from a cost-benefit perspective, a post-trade 15-minute delay tape is our preferred option, and doing all the analysis, it ranks best. A post-trade end-of-day tape adds some value. It provides operational simplification, and there is some value to be reaped from comprehensive and consolidated data, but it's very late and supports only a fraction of business processes, i.e. only those that are carried on overnight. The infrastructure for that is already in place, and given it's an end-of-day download or drop copy, it's not very complex to realize, but the benefits are also not the greatest ones. So in summary, we found and we recommend a 15-minute delay tape for equities, equity-like fixed income, covering all trading venues and all execution venues, including SI, OTC, and other bilateral trading in Europe, for this tape to be really comprehensive and to add value above and beyond what's already existing today. Once this has achieved, and it should be really a priority to launch this now and as soon as possible. In the future, and once a 50-minute tape has been realized, we find that there is potential to shortening the delay time towards close to real time, stepwise in little increments. However, not going to real time or like ultimately close to real time in a micro nanosecond perspective, because this will again introduce technical challenges, it will introduce risk of misuse, it will raise customer protection concerns. So we advocate for a speed limit, and that the consolidated tape, even in the future, doesn't lead to a technology arms race on who has the data first and best, but that it supports more business processes, but with a sensible speed limit that is also geared towards human consumption rather than high-speed algorithmic consumption. And lastly, there should always be a strong benefit case for a consolidated tape. And depending on the implementation and future development, new developments, enhancements shall only be done once a 50-minute tape or a shortened tape has provided value to the industry and more investment is justified, because it will come back to all market participants who will need to implement, who will need to act and include this in their business processes. So only move ahead and do further investments if benefits have been realized and the tape has been proven helpful and beneficial. Lastly, on our recommendations, we find that this is really a critical element in European market structure and also in capital markets, because market data today powers all business processes and is intrinsically linked to value creation for most stakeholders in the capital market space. Hence, governance and enablers for the consolidated tape are equally important to get right for a tape to be well designed. Given the importance, we think someone independent and pan-European, for example, ESMA, should run the tape and administrate the tape. There should only be one provider over the midterm and one CT per asset class to make things less complicated. The industry, both the contributors and the users, should sit in an advisory group and helping to form and shape the future direction of the consolidated tape. Thirdly, the consolidated tape needs teeth. It needs to be supported by regulation, by legislation, and by the NCAs to enforce data quality standards. With low quality data or non-comprehensive data, the CT does not provide any value above and beyond what's currently available. So it needs to have teeth and the support to really gather the comprehensive and high quality data that it needs to provide value. We think the consolidated tape should also have a revenue and a commercial business model so that we can actually measure whether users want to sign up and pay for the data. And it shall also be used to compensate the data contributors for their cost in contributing the data, notably the price forming data here. And at a certain calibration, this shall be redistributed to the contributors, but also reflecting overall the need to offer the consolidated tape data at a reasonable cost. The technical setup is important. There are solutions out there on the market that could provide such a technology. This is not the first consolidated tape that has been built around the world. So instead of building this as a European island solution, we suggest that a best-in-class technology is used, provided by a specialized vendor in Europe for this tape really to live up also to the technical standards and also simplify the connectivity to users and contributors via technical standards and interfaces. One word of caution on the consolidated tape debate. A consolidated tape, if well designed, can bring significant benefits to European capital markets. Better access to comprehensive, high-quality data. Improved outcomes for almost all capital markets processes, ranging from investment decisioning to ultimately risk compliance management and further processes. And also, it will reduce operational frictions that currently exist because institutions are using different market data that leads to process cutoffs, etc. So having one source of consolidated data will simplify things for market participants a lot. On the other hand, a badly calibrated tape will not just be a failed initiative. It will actually worsen the status quo. It will increase costs for market participants, the users, and the contributors. And ultimately, this will fall back onto investors and issuers who bear the cost of this. It can harm market integrity and lead to customer protection concerns. If some very sophisticated market participants have better market access via direct feeds quicker than the consolidated tape, there's potential for gaming and arbitrage in the market that is created. Low quality market data can lead to financial stability concerns because we all remember the financial crisis. We need good market data and good information to manage risks appropriately. And overall, it will set back the European integration quite significantly. So the stakes are high, and there needs to be a strong focus on calibrating the tape in the right way, because if it fails, it will not just be a failed initiative, it will worsen the status quo. But there are also significant benefits to be realized if we get this right. Last slide from my end, and that's also a note on European market structure and critical dependencies that exist for a consolidated tape to work. Rainer mentioned this in his speech. Currently, there is significant fragmentation across venues in Europe, not only the regulated ones, but also bilateral trading. There's huge geographic dispersion in European markets. If you go from north to south, from east to west, it's just a very long distance that has implications also for latency. Data quality is poor from some areas of the market, specifically if we look into bilateral trading. Deferral allowances are long, and all of this is aggravated in fixed income, where we think the data quality challenges are the worst. A consolidated tape will not help to cure these problems in European market structure. The introduction of a consolidated tape will not help to reduce some of these problems. The other way around, if these problems are not solved first, a consolidated tape will not provide the value that we think it will provide. And if these problems are not solved, the consolidated tape will probably just increase cost. And you heard my note on the potential risks of a consolidated tape. So it's really important that these things get addressed before or simultaneously with introducing a consolidated tape. Otherwise, the stakes are high and the status quo will likely worsen. This was it from my side. I stopped sharing the screen and I saw there are a few questions that have come in.
Yeah, I think
we'll pick them up in the panel later today.
I think we'll pick them up in the panel as we're already running a bit late. So thank you very much, Magnus. And I think I would welcome my next two guests, John Bergen and Thomas Burkl. Welcome to the two of you for our early morning fireside chat, but temperatures are getting cooler outside, so I think it's probably okay to say it's a fireside chat. Both don't need introduction, but just to say John Bergen is the Director General at DG FISMA, obviously responsible for EU-level policy and making the legislative initiatives in the respect of the financial sector, banking union, capital market union, sustainable finance, digital finance, anti-money laundering, etc. I think that's what John stands for. And Thomas Burkl is a member of the executive board of Deutsche Börse Group, and he's responsible for trading and clearing, so Xetra, Eurex, the energy markets, foreign exchange, including market data. With that, I would give Sean the floor for a few introductory words.
Thanks, Rainer, and very happy to be here to discuss the consolidated tape in the context of the upcoming MiFID review. I think it's very important for the the future of the market, and so it's useful to exchange views with stakeholders concerned, particularly those around the exchanges. But before I focus on the consolidated tape more specifically, I want to make a few more general remarks, because you've mentioned that I have a slightly wider portfolio, and I want to say a little bit where this fits into that wider portfolio. The Commission, as you know, will present an important CMU package by the end of this year, probably towards the end of November, and that package will comprise 4 parts. It will have the European Single Access Point, that's about access to data on corporations and small and medium-sized enterprises. The LTIF review, which is looking at making this more attractive as an instrument for wholesale and retail investors. The AIFMD review, which is looking at, I think, tweaking the rules rather than reforming dramatically the rules for alternative investment managers. And then, of course, the MiFID review, which looks at capital market functioning and is the vehicle for any proposal we will make on the tape. Now, this overall package is for CMU is very important, because it is the first set of legislative proposals that we're going to make under the new action plan. And I think it's also important because it's going to bring CMU back into what I would say the political limelight after a period of kind of behind the scenes preparation work. Our focus has been a little bit otherwise, attracted by other things on the agenda that you mentioned: sustainable finance, digital finance, AML, solvency, Basel. This will be the moment when I hope we can bring CMU back into the light and build some momentum behind it. So this is going to be an important discussion, and within that package, the MiFID review is going to be very important, and of course is the main focus around this event today. I have to say, if I'm frank and open, I find the debate around the MiFID review has become a little bit what I would call tape-centric. I mean, this is understandable, I think, given the sort of the novelty of the CT proposal, but I want to stress that this review is about the broader efficiency and functioning of the EU capital markets. Okay, so there will be more in the review than just a proposal on the tape, and that's important because there is this discussion about what comes first and what should come after. We don't think there's really either or here. Now, the consolidated tape is a key action under the CMU action plan. But it falls under a particular heading. It falls under the heading of the economy that works for the people. So this action is clearly focused on the benefits to the end investor, big and small. So any implied changes in the functioning of the markets due to the tape is a means to an end. So it's not an end in itself. So we want to focus through. And with any measure that is focused on the interest of the end investor, we of course need to find balances between various dimensions. So cost efficiency versus competition, choice versus transparency versus protection, etc. There's a whole range of dimensions where we have to find a balance in the proposal, and we will try to find that balance in the proposal that we put forward. Now, I fully acknowledge there are differences of views on this. I've just listened to the end of the presentation on the study about what we need, about how we need to proceed. Although I think it's very good that we seem to have now all at least coalesced around the view that there are economic benefits to the end investor from a tape if the tape is well designed. That's already, I think, an advance in this debate relative to where it was not so long ago. But from our perspective in the Commission, we believe we have to be ambitious about this proposal for a number of reasons. I mean, firstly, Brexit has had major implications for the remaining CMU 27 capital markets. We are now behind competitor markets in terms of development. There is no doubt about that. So we have to work extra hard to make our markets an attractive place to invest, not only for our domestic investors, but also we want to attract investors from outside, investors who may be even more interested in choices between us and competitor markets. I think the emerging consensus among stakeholders, both public and private now, is that CMU 27 will be multipolar. So we will not try to replicate the City of London inside the EU 27. This is fine, but it does mean that our market infrastructure will remain relatively fragmented relative to the past and relative to competitor markets. So we have to exploit, in my view, technological solutions ambitiously if we're going to compensate, I should say, for implied loss of agglomeration benefits that we had and other markets still have. So that's why we favor an ambitious approach to the tape. in addressing two main objectives in terms of market functioning. First, we want a tape to assist investors in intraday liquidity. So we want them to be able to identify the best place to execute trades in terms of liquidity. So we want to use technology to compensate for liquidity fragmentation across a wide range of infrastructures. And by the way, we're not talking about nanosecond tapes here. We're talking about tapes that deliver within seconds, but not within minutes, but not nanosecond tapes. And second, of course, we want to ensure maximum protection for investors, so typical best execution requirements, so that investors know that they have in fact had best execution delivered by their intermediaries. So, to put it bluntly, while the 15-minute tape proposed in the study would address the second objective pretty well, we don't think it would address the first objective well at all. And if we zoom out a little bit and take a more strategic perspective, we believe this more ambitious approach is needed because our competitor markets, the two big ones we now have, either have a tape already and are actually improving it, or seem to be moving pretty fast to develop a tape. So we need to move in line with our competitors. All this being said, we know there are differences of view out there, and we have to acknowledge that there are some complications that this kind of must be taken into account when we discuss the tape. I mean, the first complication is that there seems to be no consensus out there on exactly how capital markets function. I mean, the main problem here seems to be a quality of data problem, not for the first time. So we find ourselves with different studies using apparently the same data, but reaching very different conclusions about how the market actually works. So we've seen the study I've just seen the end of now, the FESE one, which thank you very much for sending to me. But we also have other studies which reach very different. And so we are at conclusions, and we are trying to balance these studies to come up with a sort of balanced judgment. Now, interestingly enough here, almost paradoxically, the tape would help to resolve this problem, because if there's a body empowered to set and enforce standards around that tape, then we would expect the quality of data about how the market's actually functioning to improve. A second complication or consideration is that we know the tape will have implications for the business models of many infrastructures. I mean, we've known that has been made clear to us. Many of these infrastructures rely on the sale of data as a revenue source. So we have to recognize this fact, and we will recognize that fact and take it into account in any proposal that we put forward. A third consideration is around governance. I must say, and you know me, I ideally favor competition in these markets. So I would like to think that this is another market we can have competition in. I'm not at all sure that a single provider is the first best option, but let's see what we can deliver. And then lastly, there is this view, and it's again, I think I just picked up the end of the study, that we should sequence things. So we should look at market functioning and market structure before we introduce the tape. Again, as I said earlier, we don't see it as an either or. I mean, I think we have to do both together. I think we cannot really reform fundamentally the market structure if our understanding of how the market actually works is still clouded by poor data quality. So, but for that reason, I'm going to repeat it, that we can't kind of do one or the other. I think we have to do the consolidated tape and look at the market structure at the same time. And again, I'll stress here that the MiFID review that's coming is not just about the tape. There will be other things in about the market structure as well. I think I've already probably gone over my 7 minutes, Rainer, so I will stop here in the interest of decency and respect of time, and look forward to the discussion that comes later. Thanks. Right.